everyone, welcome back to our Accounting 210. In this video, we continue with the chapter 12, the ungraded practice. So last time we basically talked about the method that doesn't use discounted cash flow, right? We talk about payback and then talk about ARR. We want to pay a little bit attention on the ARR part. We also talk a little bit about time value of money. We said, hey, how do you get the discounted cash flow? So today we continue. So last time we stopped here at question 26, I believe, right? So we still have these numbers there. And then question 27 is very similar with the question 26. So I'll leave this to you, and then you can work on it by yourself. Sorry, why the numbers are different? Oh, I didn't know. Are the numbers different? I didn't know this actually. So every time when you watch my video, the numbers will be different from my notes. See that? Really? I didn't know. Hey, let me know. It's my first time to notice this. I know that my accounting lab, they will generate new numbers, for different students. I actually didn't know. So my notes, oh, but that video is the same. Okay. So when you watch my video, your screen, if you do your question, your screen will be different from mine, right? Am I right? Okay. Sorry, I'm not a student. I really don't really know what you will say. So that's why I really appreciate if you can, email me whenever you have any concern, because sometimes I even don't notice the problem, because I'm not thinking about that way. Maybe my screen doesn't reflect the issue. So just let me know whenever you have any question. Okay, so next one, question 28. Let's keep studying. Said you win the lottery. Why you are so lucky? You always win lottery. Decide how you will take. Use a 12% discount. What is the present value of 17,000 a year received at the end of each year for the next 10 years? So what's this? Your first thing you need to decide, this is your annuity, right? Annuity, am I right? Annuity. So we said our present value will be the cash flow 17,000, and then we time the annuity. We need to find out the new annuity table. So that is 12% and for the next 10 years. So for next 10 years, 12% will be 5.65, right? Time 5.65. So if you do that, I'm not, obviously I'm not going to do, but I just click the calculator. So 96, so that's what you will get, right? Straightforward. So let's look at next one. Assuming the interest rate is 14 per present value received 9 years from now would be okay. So this one is different. This one is still said, hey, asking about present value of 50,000. You should receive 9 years from now. So it doesn't say every year for 9 years. It only says 9 years from now. So we should use the $1, right? So we should use the $1. So it will present value will be 50,000, and then we time just the one time you should use this one. 14%, 9 years, 0.308, right? 0.308. So that will give you 50,000 times 0.308 gives you choice A, right? Choice A, perfect. So let's look at next one. Let's look at next one. Said, you raise one lottery, you will get 3,000 at the end of each of the next 15 years. So I'll leave this to you. You should decide whether you use one time or use annuity. I'll leave this to you. And then present value of this received in 11 years is very similar with the question we practiced. So I skip that one. Assume an interest rate 6% present value received at the end of each year. At the end of each year for 6 years would be, you decide, right? You decide. Next one. Net present value and the internal rate of return are example of discounted cash flow used. That's correct. We said, hey, NPV and IRR, they both use discounted cash flow. They both use discounted cash flow. Next one. A residual income is considered in a net present value computation. Yes, this is we said we will do practice later, but we said, hey, if there is a residual, let's say at the end of the project, right? So investment T equals to 1, T equals to 2, T equals to 3, T equals to 4. I'll just make up a number. It's not this question, but at the end of the year, after you get the cash flow, you will also get the residual. The residual will be extra cash inflow, and then you have to take it in the calculation. Next one, the interest rate that makes the net present value equals to 0 is the net so we said the RRR is the rate that makes your NPV equals to 0. That makes your NPV equals to 0. Very good job. I'm telling myself, hey, yeah, very good job. When evaluating capital investment, if the internal rate of return is less than the required rate of return, project will be accepted. No, this is wrong, right? We said this is in your homework quiz. I said, hey, you borrow money from the bank. The bank required rate of return is 10%. You invest in the ice cream, let's say ice cream store, and the internal rate for this project is only 8%. You borrow that 10%, but you only got 8%. Not a good deal, right? Not a good deal. Next one. In the general rule, when using IRR to decide whether to invest, is that if the IRR has to be exceed or at least the same as your RRR, right? At least the same or higher. Exceeds. Okay, let's look at this one, asking about net present value, right? You definitely will have a question. You definitely will have a question. You definitely 100%. I guarantee you definitely will have a question of the net present value. Sorry, I just like the rainbow. Sorry about that. I'm a woman. Okay, sorry. Okay, next one. Let's look at the NPV. Okay, to get NPV, you have to do 2 steps. First, you have to get the present value, and then you get the net, right? Net present value. The way I do it is I like to draw a timeline, kind of line for the time. Oh my goodness, but this is 8 years. So let's look at this. Analyzing special investment will the project will require the purchase of 2 machines for 20,000 and 10,000. Okay, so you will have to spend 20,000 and 10,000. So totally you spend 30,000. The total residual at the end of the project. Okay, at the end of the project will generate cash flow per year over 8 years. Required rate of return was the present for this project. Okay, so at the beginning you have to buy 2 machines, right? So its outflow is 30,000, right? So outflow is 30,000, 20,000 plus 10,000. T equals to 1, T equals to 2, T equals to 3, T equals to 4, 5, 6, 7, and finally it's 8, right? So finally it lasts for 8 years. It lasts for 8 years. Hey, come on. It lasts for 8 years. Okay, it lasts for 8 years. Okay, and then what? And then every year it will generate a cash flow 12,000. So every year 1, 2, 3, 4, 5, 6, 7, 8. Every year you get 12,000. Okay, so every year you get 12,000 cash inflow, and at the end of the project, you will get a you will get residual 1,100. Okay, you will get another cash flow is 1,100. So asking about net present value. Straightforward, right? So first thing is we need to get the present value of all the future cash flow. Let's look at the table. What they give us is period is 6, 8, 10, 12, and then 4, 6, 8. Okay, so we have 8 period. Okay, I say what they will give us. Okay, and then this is okay. So first thing is every year you get this 12,000, right? Every year you get this 12,000, and then this is annuity for 80 years, 4%. So we need to get annuity 4%, 80 years, 4%, 80 years. So it will be 6.733. But remember, we still have this residual. Residual is extra cash flow. So you got 1,100 and then time what? You need to know you have to time present value of $1. Now you go to present value of $1 and then you use eight years because this is at the end of 8 years. 8 years 4%. 8 years 4%. You time 0.731. So if you do the math, okay, if you do the math, let's do the math together. The first one is 12,000 times 6.733, so gives me 80,796, okay, 80,796. And then second one is 1100 times 0.731, so gives me 100, okay, 100 4.1, okay, and then you add your first, you add your 8796, you get the number 600.1. Okay, so are we done? Are we done? Yes or no? Hey, he said, oh, it's definitely not done because there is no choice like this, right? There is no choice. Okay, but why we are not done? This is just your present value. This is just, we need to get our net present value. So we need to deduct, we need to add our initial net investment. Outflow is outflow 30,000. Okay, you have to add the outflow 30,000. Now you got your NPV. So we subtract the 30,000. 1, 2, 3. So we get 51,600. Oh, let's see. Let's write yes or no. Okay. Oh yeah. Oh yeah. Oh yeah. Oh yeah. Okay. Next one. You are doing this 2 machine with it's almost the new machine will be this useful for 6 years. At the end of that, you will have residual and you can saving this and then has a okay. I'll leave this one to you. You have to know how to will get this NPV. One more time, you definitely will have a question about the NPV. Okay. Okay. Next one. Next one. Let's look at next. Hey, why so slow? Okay. So this similar one. Okay, next one. Okay, next one. Talking about this, you consider purchase a new life. The machine will have an initial investment usable 10 years and 10,000 residual. You have annual saving from this for 10 years. Very similar again, right? Very similar again. I'll leave this one to you. You can see I'll put a lot of practice, similar practice, but NPV definitely you will have a question. So make sure you know this type of question. Next one. That the net present value also similar questions. Okay, you do it by yourself. Okay, so you have this cost, this have used for 4 years. At the end of this residual 1,000. So it's very similar, right? Very similar. You have a residual. Every year. You have a saving. The saving will be counted. The operating cost saving is counted the same as extra cash flow. Because think about this, you save 10,000, it's the same as you get extra 10,000. Okay, so cost saving will be similar in our NPV calculation. It's similar as your extra cash flow. So you put, instead of 12,000, you put 8,900. Next one, asking about the NPV, also said you have this, and then you will have useful life of 8 years and cost 8,000, residual 6,000. Okay, so you do this by yourself also. You have annual cost saving 17,050 is the similar as you have extra cash flow $17,050. Next one, let's see, IRR, right? Asking you IRR. Okay, next one, I like IRR. Let's look at this one. Considering purchase of a machine cost is 22,712. Use for 5 years, machine will generate 6,300 the next 5 years. Asking about IRR. So we said, how do we get IRR? Remember we said we got this IRR by checking the table. So IRR is when the NPV equals to 0. Okay, the IRR is when the NPV equals to 0. How do we got our NPV? We first need to invest. We first need to invest 22,712, right? And then every year you get a cash inflow 6,300. And then we need to time the discount factor. We get this to be 0, right? This is how do you get NPV. And then, so our first step is we need to get the factor, discount factor. So 22712 divided by 6,300, you get a discount factor. So you get a discount factor as to be 3.605. Okay, you got a discount factor around 3.605. Now we go to look at the table. We have this two table, and you know it has to be your annuity because you got it for each of the next 5 years. So you got the annuity. We said it's 5 years. Your discount factor 3.605. You look up. Look up. What's the return? You get 12%. That's it. You got a 12%. Okay, you got this 12%. Okay, next one. So this is how you get IRR. I would say very likely you will also have a question like this for the IRR. So make sure you know this one. And then next one, similar, also asking about IRR. I'll leave this to you to study. And then IRR also, okay. I really put a lot of questions. What's the IRR? So you can say this one is you make the NPV equals to 0. Make the NPV equals to 0. Okay, let's look at this one. Asking you about the present value. Asking you about just the present value of all the future cash flow. So you do not need to do the net present value. You just need to do the present value. So let's look at the present value for F54. Make sure you know which one is which, right? So you have annual net cash inflow for useful year is 28,000 every year, and then you have a residual 6,000. You have a residual 6,000, okay, and then it will be used for 6 years, right? So I'm not going to draw the line. Let me draw the line anyway. So sorry about that. So at the beginning, you are going to invest, but we don't worry because we only think about future present value. So T equals to 1, T equals to 2, 3, 4, 5, 6. So every year you get 28,000. Every year you get 28,000, right? Every year you get 28,000. At the end of the 6th year, you get extra 6,000. So what is the present value? Your present value will be this 28,000, and then we time the annuity. We time the annuity 6 years, and then 8%, 6 years, 8%. You time this 4.623, right? And then last year you have this 6,000, but it's not annuity. It's just a one time. It's just a one time. 6 years, 8%. 6 years, 8%. 0.630. Okay, 0.630. And then if you do the math, you will get the answer. So 28,000. Sorry, 28,000 times 4.623 gives you 129,444 plus your 6,000 times 0.630. So 3,780. So if you do this, you add 129,444. What did you get? 133,224, right? So this is asking you just the present value. It doesn't ask you the net present value. So make sure you do not need to deduct the net initial investment. You do not need to deduct the initial investment. Be very careful when you do the questions. Make sure you know what question asks you. Next one asking about the net present value, right? So I'm not going to do it, but the only different, it's definitely different numbers, so I have to redo it. But You just get the present value and then you subtract the net in the initial investment, because this is outflow. This is outflow. This is your inflow. This is your outflow. You net them, you will get the net present value. Next one, asking you about net present value for the snack machine. So similar questions, and then asking about net present value for the India proposal. You know, initial requirement every year you get this and you have a residual. Similar questions for the next one, Kentucky. I put so many questions, right? Asking about present value, okay? Present value, okay? So this is just this one. You just get the present value. You have every year, you also have the residual. So for every year, you use the annuity. For just the residual, you use one time $1 amount. Next one, similar, asking you net present value. And the last one, method are based on cash flow, profitability, and time value of money. Okay, so which one is based on cash flow, profitability, and time value of money? What's this? What? 1, 2, 3. Okay, okay. So time value of money is IRR. It cannot be. Okay, which one based on cash flow, profitability? Okay, which one is cash flow? Okay, accounting rate of return is not cash flow, but payback. Sorry. Which one is based on cash flow, profitability, and time value of money? I have no idea actually. And net present value. Net present value. I think it's NPV and IRR, because ARR doesn't based on cash flow, payback doesn't based on profitability. Let's check. Who knows? Oh, I'm so smart. Okay, I stop my video by saying I'm so smart. Okay, so you can say I'm not going to do everything. I don't want to make it so long and let you sleep. So get the concept and practice. You will get the right answer. Let me know if you have any question for all the chapters or regarding your exam or the point. Thank you for spending this wonderful semester with me. Thank you. Bye.